understanding money management and how needed funds are acquired. Finance is a broad term that describes activities associated with banking, leverage or debt, credit, capital markets, money, and investments. Basically, finance represents money management and the process of acquiring the needed funds. Finance also encompasses the oversight, creation, and study of money, banking, credit, investment, assets, and liabilities that makes up financial system. Many of the basic concepts of finance originate from microeconomics and macroeconomics theories. One of the most fundamental theories is the time value money, which essentially states that a money today is more than a money in the future. Because of individuals, business, and government entities all need funding to operate, the finance field includes three main subcategories. These are personal finance, corporate finance, and public or government finance. Financial planning involves analyzing the current financial position of individuals to formulate strategies for future needs with financial constraints. Personal finance is specific to an individual's situation and activities. Therefore, financial strategies depends largely on the person's earning, living requirements, goals, and desires. Individuals must save for retirement, for example, which requires saving or investing enough money during their working lives to fund their long-term plans. This type of financial management decision falls under personal finance. Personal finance includes the purchasing of financial products such as credit cards, insurance, mortgages, and various types of investment. Banking is also considered a component of personal finance because individuals use checking and saving accounts as well as online or mobile payment services such as PayPal, Venmo, GCash, and many others. Corporate finance refers to the financial activities related for running a corporation, usually with a division or department set up to oversee those financial activities. One example of corporate finance is a large company may have to decide whether to raise additional funds through a bond issue or stock offering. Investment banks may advise the firm on such decision and help it market the securities. Startup may receive capital from angel investor or venture capitalist in exchange for a percentage of ownership. If a company thrives and decides to go public, it will issue shares on a stock exchange through an initial public offering or IPO to raise cash. In other cases, a company might be trying to budget its capital and decide which project to finance and which to put up on hold in order to grow the company. All these types of decisions fall under corporate finance. Public finance includes taxing, spending, budgeting, and debt issuance policies that affect how a government pays for the services it provides to the public. The government helps prevent market failure by overseeing the allocation of resources, the distribution of income, and economic stability. Regular funding is secured mostly through taxation. Borrowing from banks, insurance companies, and other nations also help finance government spending. In addition to managing money in a day-to-day operation, a government body also has social and fiscal responsibilities. A government is expected to ensure adequate social programs for its tax-paying citizen to maintain a stable economy so that people can save and their money will be unsafe. Financial services are processes by which consumers and business acquire financial goods. One straightforward example is the financial services offered by a payment system provider when it accepts and transfers funds between payers and recipients. This includes accounts settled via checks, credit card, debit cards, and electronic funds transfer. Financial services are not the same as financial goods. Financial goods are products such as mortgages, stocks, bonds, and insurance policies. While financial services are tasks, for example, the investment device and management a financial advisor provides for a client. The financial services sector is one of the most important segments of an economy. It drives a nation's economy, providing the free flow of capital and liquidity in the marketplace. It is made up of a variety of financial firms, including banks, investment houses, finance companies, insurance companies, lenders, accounting services, and real estate brokers. When this sector and a country's economy are strong, consumer confidence and purchasing power rises up. When the financial services sector fails, it can drag down the economy and lead to a recession. Financial activities are the initiatives and transactions that businesses, governments, and individuals undertake as they seek to further their economic goals. They are activities that involves the inflow or the outflow of money. Examples includes buying and selling products such as assets, issuing stocks, initiating loans, and maintaining accounts. When a company sells share and market debt repayment, these are both financial activities. Similarly, individuals and governments are involved in financial activities such as taking out loans, levying taxes, which further specific monetary objectives.